Hello, everyone, and a very warm welcome to today's major markets update for Wednesday, March the 22nd, 2023. Thank you for your patience and understanding. While my electricity was out, we got it back and we're on track. So you're the first one to get the video update on time. Of course, I had to do a lot of things before I could get to the charts. But let's go straight to the charts. And actually, before we get there, bottom line. Today simply does not look good. Most indexes have so far only done 3 waves up. That's why we're tracking, as you remember, green A1, B2, C3. So far, it looks like C3 has topped. That's all there is to it. NASDAQ and NASDAQ100 are still the most promising looking in the sense that they could still try for 5 waves up, followed by the S&P500. But in my humble opinion, it can only do a leading diagonal, and those should not be relied on. Those are very, very unreliable. The Dow Jones and the IWM look weak, and the semiconductors may also have topped at a CSA extension, larger CSA extension. So remember, please use my target zones for low risk buying and selling. I'll show you the NASDAQ 100, which has nailed every single target zone. Sometimes the market goes a little bit above it. That's fine. You can rebuy and trade accordingly, or it won't reach it at all. But that's happens rarely. All upside targets are reached. That simply means sell. There is no questions asked from an Elliott Wave perspective. Target zone reached, sell. No questions asked, because this is not a bull market. So please do not overstate your welcome. If you do, you'll probably have to look at a 90% drawdown. Okay? That's the ramification of a bear market. So please, it's better to get stopped out for a small loss than sitting through a 90% drawdown, which you will see in the slides if you read them. The benefit of having a stop loss in place, because at the end of the road, you have double your money while everybody else is hopefully back to break even. So if we go below the March lows, we're going to 3700s, below that the 2000s. Again, as I stated before, seasonality is all great, nice and dandy. It doesn't really give us much about the actual amplitude and direction of the market. It simply tells us where we should expect highs and lows. We were expecting a high around March 21, 22. We got it, and we should now be going towards a low March 23 something. I'll show you that in a minute. Please remember, the Fed has raised 0.25%. This is, in my humble opinion, very irresponsible. The Fed is not having your back or my back or anybody's back anymore. It is not supporting the financial markets. It doesn't want to prop it up. It wants to destroy it. That's its modus operandi right now. Because raising rates in an already heavily stressed financial/banking system is really irresponsible. As if these 3 market or bank meltdowns mean nothing. Please be aware that which bank is it? With the Capital One Bank is now also starting to see heavy credit default swaps. Do with it what you want. Please remember, the Fed wants much, much lower stock prices because it helps reduce inflation. I showed you that last weekend with the sticky inflation versus stock market relationship. It seems like they do not care about your money, your savings, your job, your health, your well-being. Not at all. They're only focused on this silly little inflation number. I couldn't care less about inflation. It's fine. It's my humble opinion, the signs of a economy that's going booming and not crashing. Crashing economies are the worst for everybody. So in fact, unless you're blatantly naive and you're living under a rock at the same time, it is obvious to me, at least, that since 2020, I still have some hope, but that hope is completely squashed. The entire government, United States and around the world, except for a few righteous individuals, do not care about any of its citizens at all. Not at all. Rant over. I know it doesn't help you much with your trading, but please take this into consideration. Please read my book, Tomorrow Happened Yesterday. I did a tweet about 7 books that will tell you the shit show we're in. Okay? We're in a shit show, and that's what it is, and it won't end till 2034. Period. So, moving on, this is the shit show we're in. We could already be in this blue wave C. Okay, B waves are insanely tricky. We've reached already 41.96 got to 41.95, so we've technically done enough for this B wave, and it means we can now go down to 2800s. Sit through it if you want. I don't. I went entirely cash before the Federal Reserve meeting, and got a little bit on the long side, a little bit on the short side afterwards, and that's it. I'm 100% cash in all my trading accounts. This is the importance of stop losses, okay? Sit through a 90% loss and go back to break even, or twice the money. You make 200,000, sell for a little loss, rebuy, you make $400,000. I'm sorry, I cannot stress this enough. So with that in mind, let's have a look at the NASDAQ. So the NASDAQ almost came here to the 161.8% extension. We could have made 5 waves up, 1, 2, 3, 4, 5. Okay, so it's possible. It's a little ugly because normally the 161.8% extension is reserved for the third wave. Okay, which we got if we look here at the NASDAQ100. So we have 1, 2, 1, 2, 3, 4, and then 1, 2, 3, 4, 5. A very extended 5 of 5. It's okay. The blue target zones here show where I expected, based on standard Fibonacci-based impulse pattern, this orange wave 5 to top. Wave 3 did an exact 161.8% extension. Wave 4 did a perfect retrace to the 100% extension. And then normally wave 5 goes to the 200% extension, which in this case would be 12,775-ish. It didn't. It extended. Okay, it's just some externalities, whatever Powell blurps out of his rotten mouth. I'm sorry, I have no respect for the gentleman at all. We got an extended 5th. It's fine. You nail the 3rd, you nail the 5th, 4th, and then the 5th does something else, or vice versa. This is always where we say, you know, you get it right 3 to 4 out of 5 times. So that's simply as accurate you can be. So if you were long, you should have sold in these target zones, and then if it spiked higher, great. You want to chase it, great, fine. Make sure you set the right stops and raise those stops, because you can see how quickly the market takes any profits away. So we are now in a decline, which could be wave 4. This is why we label A1, B2, C3, because we don't know if we're going to get 4 and a 5. Since 2020, every single time we've actually looked at it, it seems like this 4-5 setup falters and completely does not appear. Normally, a retrace of a 1 degree higher 4th wave goes pretty much back to the start of the 1 degree lower 5th wave, gray wave 5, minute. So we can still bottom here at about 12,430-ish. We don't have to, okay? We could even drop here to about 12,300. If we go below 12,300, not good. So we could have done 5 waves. It's a little ugly, but it's possible, because normally this extension here for this wave 3, this is the NASDAQ, this wave 4 are reserved for a 3rd of the 3rd wave and a 4th of the 3rd wave. And then 161.8, as you can see, is then reserved for the actual 3rd wave. So this one can still drop here for the NASDAQ to 11,540 and a little bit before we rally again for a wave 5. So NASDAQ still has hope. And then we look here at the Dow Jones. The Dow Jones looks rather ugly. When I did my update, it still looked okay for a potential 4 or 5 for this leading diagonal, but it starts to look rather miserable. So this is quite overlapping. We're getting already extremely oversold, but as you can see, oversold can get much more oversold. And this is just the unfortunate nature we're dealing with. We broke out. This green arrow was the breakout that I showed before. If we would break out above this level at about 32,300, we could target to potentially as high as 33,300 plus or minus 100. And that is, or 1,000, sorry, and that is about where we got this. See, we missed this target zone by the slightest. We did get an impulse higher, so we have A, B, C. But this again starts to look ugly. It just doesn't look good. I'm not happy with this chart at all. S&P500 as well. The last minutes, this got sold off, unless something is completely wrong with my charts. Let's see here. I'm gonna because I sometimes just don't even believe what I'm seeing. Yeah, it is correct. I'm looking here on my iPhone. Also here, we have the potential for a leading diagonal. Okay, this wave 4 in green should at bottom out between 38.96, 39.24. Okay, but I'm not going to count on it. I'm not going to count on it. When I updated my charts, as I was looking, I was like, okay, we reached the target zone here. almost 261.8% extension. We topped here for wave 5 of 3, as showed yesterday, 4 of 3, and then 5. In this case, actually C, because all we're doing is an ABC higher. So we have an ABC up and the ABC lower, and then a ABC up again in gray. Okay, 5, 3, 5. Beautiful. 1, 2, 1, 2, 3, 4, 3, 4, 5. So we can be still in this wave 4. Okay, we can be. Well, I'm not going to trust it until I see it. That is just the nature. So we have to be very cautious about this. I can't say it often enough. This market is not proving me anything, just giving me the hippie jippies. And as I said, this is for me a market that's green and gone. If I buy SPXL at 69.10, I'll sell it at 69.20. And I'll repeat it over and over again, because that's the only way I reliably want to make money. I know I tell you these target zones to use, and you should. But, you know, personally, I'm very jittery about the markets. So we have reached the upside target zone again as well. That's where you sell, and that's where you have to be very cautious once we reach that target zone. Very cautious. So potentially a 4. Okay, we can overlap, but I'm not going to trust it. That's why I label it 4 question mark, 5 question mark. Market needs to prove it to me. Don't see it yet. Because if we don't, then all we got was 3 waves up for this 1-2 setup. And we're going to do 3, 4, and 5 into the 2800. All right, as you remembered from the slide. Then we just completed wave 2. The floor in the market is the March low. End of story. This is then the alternative for doing some leading diagonal 1, 2. I'm not really looking at it. So we had passed the bearish cutoff for this red wave C/Y. It means, in this case, yes, this decline has ended. That's all this means. This decline has ended. All right, it's the same here. This decline, wave 1, has ended. Wave 2 is then underway. And we know if we go below the March lows, then this counter trend rally has ended, and we're then going to get 3, 4, and 5. Okay. Semiconductors. So this is what I was looking for in around December, January of last year. When we topped, so we decline and then we rally. The blue arrow. That was the rough path we had in mind for the semiconductors. I have not changed this chart at all. So actually, I think this is from late December. We got it pretty decent, okay? Pretty decent. This is the foresight one can have with Elliott. No, we don't get all the gyrations correct and all the internals of the daily market moves, but we get the general gesture of the market correct. I was probably a little too optimistic here, but again, what we're looking for is down and up we got. Then yesterday I presented the view that we could be in this subdividing wave 5 of C of B, okay? This potential. As long as we hold the March lows, this is possible, okay? So we should now be in this green wave 2 with this wave count in mind. Of course, when we drop already below, I would say 3,000, it starts to suggest this is not going to happen. And we go below 2850, then this entire counter trend rally has completed A, B, C, and then we have this, where we have reached a C is A relationship to the T. We failed even with the 5 is 1. Upside disappoints in bear markets, but this is enough. The market has done enough. 1, 2, 3, 4, 5. 5 wave, C wave, game over. We're going to go well below the October lows. And again, as I said, seasonality be damned. As long as it tracks, it's great. It's just an average of 95 years of data. If we break below a certain key level, all bets are off. Again, seasonality is not something we're going to hang our head on, but it allows us to identify highs and lows. If seasonality has the same highs and lows but trending higher, whereas the market goes lower, but we still hit highs and lows to the same tune, I'm fine with it. I'm not going to look at the absolutes. IWM looks incredibly messy all of March, pretty much. This doesn't look great. This looks like a weak market, and I think this one has topped for blue wave B, ABC. Again, it came to 199. I was looking for 200. Excuse my inaccuracy. And I think this is not looking great. So that brings me to here, Credit Suisse. Well, highly respected bank, in my humble opinion. What could go wrong with this one? Well, the market already told us about 20 years ago, a lot went wrong with this one since 2007. This is why, in my humble opinion, you should never average down. Keep buying lower and lower and lower. There is no floor. There is nothing. This is why DCA, dollar cost averaging, is a horrible strategy. What's your time frame? If you'd invested in this one and keep buying lower and lower, you're on the wrong side of the trade already anyway. Don't do it. Unless you hedge. But why hedge this if you can catch something that goes the other way around? Okay. Just make sure don't do it. At the most, average down once, and then it's hands off because you're already on the wrong side of the direction of the trade. Okay, well, that's all I have for today. I'm sorry, it's not the latest and greatest news, but remember, today it does not look good. I've only seen 3 waves up. We need to hold the March lows. If not, we can easily go to the 2000s, because remember where we are in the bigger picture. We are in a super cycle 4 wave. This wave is pretty much measured after the 1968, 1974 period, where we also had high inflation, high demand for workers, and a market crashing as well. Ultimately, it bottomed May 1974. It lasted 6 years. Now, that was a primary 4. Okay, cycle 4 lasted from 2000 to 2009, 9 years. So it might be logical to assume that super cycle 4 is 12 years, 6, 9, 12. Okay, why not? Let's keep it logical. So we can have technically now topped for this C of B, and we're gonna go to the 2800s. From there, ideally back to new all-time highs. That's what happened in the 1970s as well. We made new all-time highs because essentially all 4th waves since the 1930s low have been either irregular expanded flats or regular flats. All of them have been flats. So it's very logical to assume that this super cycle 4 will also be a flat, and most likely of the irregular kind. Why? Because the top in 2022 was weird. I was looking for 5,300, and when the 3rd wave doesn't do it, the B wave will do the trick. Same here in between 2018 and 2020. The market stalled here at around 3,000, and I kept looking for about 3,300. It was off. The 3rd wave missed it. The B wave did the trick. Every single time, it works all the time. All right, so please keep this in mind. Money to be made, plenty to the downside if we break lower, and then plenty to be made back to the upside, because I think here a lot of things will start to break, and the Fed will start to scratch its head, because they are always behind the curve. It must be great to have that job, to never be actually forward-looking, but behind it. I'm sorry, I've lost trust in all those incompetent schlemiels. That is a term by Steve Pinkert from his book Enlightenment Now. And those people and our entire government does not seem to be enlightened much at all. Well, sorry about all this opinionated ranting, but I hope you can appreciate it. So this is what we're looking at. Time frame wise, this is why I'm looking for 2034. I can go to the oil relationship, the Dow Jones and oil relationship as well. I can maybe pull that up for you real quick. If I have the slide, give me here. So this is from my book, Tomorrow Happened Yesterday. It's available on Amazon. I wrote this in 2020. Okay. I wrote this in 2020, and 2020, I thought super cycle 3 may have completed. These are pages 22, 24, 25. Okay. I thought super cycle 3 could have topped in 2020, and we're in super cycle 4. So I've been looking at this one for a long time already. I said here, the only caveat is that the bulls may have one more chance, as my analysis could be off by 1 wave degree. So the low in March 2020 was not the start of super cycle 4, but it's only primary 4 of cycle 5 of super cycle 3. And that was the case. It means the last primary 5 wave to new all-time highs is underway. It should last several months and ideally top out in the spring of 2021. Okay. I assumed the index would continue to follow the presidential election year pattern. It did not, but it had recaptured that. And I assumed that Dow Jones would follow the 10-year delay with crude oil. Namely, Tom McClellan has found this 10-year lag relationship where oil leads the Dow Jones. So the oil topped in April 2011 and had then a long, ugly downtrend into February 2016. So if the Dow Jones is going to follow oil's previous path, and there was back then nothing it wouldn't, and so far so good, it should mean the top for stocks is due around April 2021 and a bear market crash into 2024. Right? And the ultimate bottom in stock market should not be happen until the spring of 2030. Right? Far ahead, but we're still on track, and the super cycle 4 aligns quite nicely. This relationship has worked for over 120 years, and that is for Tom and for me long enough that it should be respected, continuously monitored, and we must accept its imperfections, meaning it doesn't have to top April 2021. What's on the 10 years, 6 months? What is on 120 years, 6 months off? Nothing, okay? So, as I wrote in my book, ultimately, this final wave up will complete super cycle 3. So, back in March 2020, when I wrote this book during the pandemic lockdown, I knew the market was at a crossroads. Pay me now or pay me later. Okay? The bill will come due, and it is paying. It is coming due right now. So we're merely delaying the inevitable because in Elliott Wave, we know 4 always follows 3. And after supercycle 4 comes supercycle 5, many decades of good things ahead. So please keep this in mind, where we are, protect your assets, and make sure from a trading perspective, green is gone. Take care, trade safe. See you all on Friday. And if you haven't bought my book, Tomorrow Happened Yesterday, please do so. It's only 150 pages. You read it in one night. Take care, trade safe. Have a great rest of your day.